Hello and welcome. Before we start, please subscribe to our YouTube channel for news and updates. The stock market has stumbled with the S&P 500 and Nasdaq declining year to date. While tariffs have garnered the most attention, investors are also concerned about mixed economic signals, including weak consumer confidence, hotter inflation, government worker layoffs, and more. Some are now wondering if there will be a recession, and the administration did not rule out the possibility in recent interviews. How can investors maintain perspective in this challenging market and economic environment? Uncertainty around economic policy has increased. To start, it is important to understand the difference between how individuals and households feel about the economy versus what drives financial markets. For example, when the prices of everyday goods and services increase, this can present challenges for our personal budgets. However, it may create potential opportunities in investments that can benefit from price increases. So it's important as investors to remain objective and distinguish between our personal experiences with the economy and the factors that influence long-term investment returns. While the economy and stock market are not the same thing, they influence one another in important ways. When economic growth is strong, corporate earnings tend to grow, which can boost share prices, and vice versa. Instead, not only has the economy grown steadily in the past few years, markets have also performed well. Despite the current pullback, the S&P 500 has gained over 60% since the market bottom in late 2022, while the Nasdaq has risen 78%. Why have recession concerns risen? A possible trade war represents an outside shock to consumers, businesses, and global supply chains. Additionally, slower growth, or even 2 consecutive quarters of negative growth, are quite different from situations like the 2008 global financial crisis or 2020 pandemic shutdown. It's important to remember that tariffs are often used as a negotiating tactic for broader policy objectives. In the past, market reactions to tariff announcements were more dramatic than their actual economic impact. In 2018, the market fell as tariffs were implemented, but earnings growth was still strong and GDP was almost 3% that year. The economy has grown steadily despite investor fears. Beyond tariffs, the economic data is causing concern, including hotter than expected inflation and mixed jobs numbers. For example, the Consumer Price Index reversed course recently and rose above 3.0% for the first time since last summer. Adding to this uncertainty, federal government jobs fell by 10,000 in February, according to the Bureau of Labor Statistics, and more are expected. While federal workers account for less than 2% of the workforce, there is concern of ripple effects on the private sector and job growth overall. The price sensitivity of the consumer and their outlook on the job market have also worsened. Consumers now expect inflation of 3.5% over the next 5 years, the highest level since 1995, according to a University of Michigan survey. This has translated into feelings of deep pessimism about their financial situation in the next 5 years. The irony is that markets have forgotten about the reasons for their post-election optimism, the possibility of pro-growth policies around manufacturing, energy, taxes, and regulation. As the chart above shows, consumer spending has driven the economy in recent years. Some economists hope that policy changes could boost business spending as well. The S&P 500 experiences pullbacks on a regular basis. While the thought of a recession can be unpleasant, it's important to remember that periods of slower economic growth are a natural part of the business cycle. Forecasts are not always correct, and even when they are, markets do not always behave in expected ways. While the past is no guarantee of the future, the market declines, and subsequent sharp recoveries in 2020 and 2022 are recent examples of situations where markets can quickly change their tune. Similarly, short-term market pullbacks are a natural part of investing. As the accompanying chart shows, the S&P 500 experiences pullbacks on a regular basis, even as it has risen in the long run. It's important to maintain a broader perspective amid heightened economic concerns. The bottom line, the possibility of a recession is back on investors' minds, but long-term investors should maintain a broader perspective. While tariffs have increased uncertainty and some economic data has been mixed, history shows that staying invested through challenging periods is the best way to achieve financial goals. Thank you for listening. For additional information, please visit mraadvisory.com.